In the U.S., 3% of all stocks change hands each business day. To facilitate this exchange, the ownership of publicly listed companies is thinly sliced into equal shares, hence the synonym for equities, shares. The word company originated from the word for bread. So to help us better understand company ownership mechanics, let's discuss a person going to the stock market to buy some shares in parallel with a person going to the supermarket to buy a loaf of bread. Let's discuss slicing and pricing. Both a loaf of bread and the ownership of a company are sliced up into equal portions to make life easy for diners and investors alike. The number of slices of each is decided by the baker and the company treasurer, respectively. The number of slices of bread multiplied by the thickness of each slice gives you the size of the loaf. Similarly, the number of shares of a company multiplied by the price per share gives you the size of the company, otherwise known as the market capitalization. Both a loaf and a company can be thickly or thinly sliced. At the end of the day, people care about the overall size of the loaf or company. This enables them to determine whether it's a bargain or not. While this slicing of the loaf and the company is analogous, the pricing convention is different. While bread is priced by the loaf, companies are priced by the slice. Notwithstanding this pricing convention for companies, when valuing a company, investors really care about the price of the whole loaf, that is, the market capitalization. This is why our ears prick up when we hear that a stock has doubled or halved. This tells us that the size of the loaf has doubled or halved. On the flip side, when pundits reference solely the prices of shares, it tells us nothing. A rookie mistake is to compare one share price to another. Is it meaningful that IBM is worth $158, whereas Apple is worth $124? No. That's like trying to compare the size of one loaf of bread to another by looking at single slices of each. In a related way, newcomers to finance may be attracted by so-called penny stocks, thinking that they must be a bargain. But this is like hunting around a supermarket for the thinnest sliced loaf of bread. In both instances, you are choosing the loaf or the stock using very peculiar criteria. Let's show how slicing and pricing works using Apple on one day in history, March 12, 2015, just before they launched the Apple Watch. On this day, we pulled up the description page for Apple by typing Apple into the command line, selecting Apple, and going to the security description. The number of shares outstanding for Apple was 5,825 million on March 12, 2015. The price per share was $124. Therefore, the market capitalization was $725 billion. If an analyst at that time had a target price of $170 per share on Apple, he was declaring that he thought Apple equity was worth over $1 trillion. You cannot change the size of the loaf by tampering with the number of slices. This concept is most obvious when companies do stock splits and reverse stock splits. A stock split is when a company feels that its share price is too high for retail investors, so it divides each share into two or more shares. A reverse stock split, also known as a stock consolidation, is the opposite. To get some really good stock tips to wow your interviewer, simply look for proposed reverse stock splits that will happen the day after your interview. Cite the current share price in the interview, for example, $42, and say, "I reckon it'll multiply." To locate stocks that are indeed about to literally multiply, type reverse stock splits into the command line and select NISPLREV, the news code for companies proposing reverse stock splits. But don't get greedy. To avoid suspicion, simply select the company with the lowest proposed reverse stock split, such as 1 for 3, as we can see at the bottom of the screen. The interviewer may think the one you picked immediately tripled, and then tell all his managing director buddies about the hotshot he's about to hire. And even if the interviewer does spot your subterfuge, you will likely get partial credit for understanding share price mechanics. Conversely, to locate stocks that are seemingly about to have, type stock splits into the command line and bring up NISPL to see news on companies that are about to do stock splits. This is ideal if you think you're going to be asked for a short. Let's move on from share price mechanics to see how people form opinions on how big the loaf should be. Share prices are facts, while valuations are opinions. Remember from the Jenny example that equity holders own the residual cash flow. Therefore, when valuing companies, shareholders care deeply about earnings estimates. Economist John Maynard Keynes once said, "When the facts change, I change my mind." Analysts tend to change their earnings estimates for a company after quarterly earnings announcements and after any other news that forces a rethink of the company's prospects. Let's demonstrate this with an example. Facebook. The Facebook IPO was in May 2012. The share price remained below the IPO price for the following year. Then, in July 2013, Facebook surprised the market with very strong earnings. This was due to surging demands for mobile advertising to Facebook users via their smartphones. Facebook continued to surprise the market with stronger than expected earnings. In 2014, Facebook's user base overtook the population of China. Let's look at how these surprises affected the earnings estimates for Facebook. If we type estimates into the command line and select the earnings estimates graph or EEG function, we can see that analysts began to increase their 2016 sales estimates for Facebook from mid-2013 onwards. These continuous estimate upgrades sent Facebook shares up from $26 in mid-2013 to $115 by the end of 2016. This stark example shows how estimates can drive share prices. But still, the two questions remain. How do you get from earnings estimates to share price estimates? And what value do you assign to earnings estimates to assess fair market capitalization? There are two common ways in which investors value companies: absolute valuation and relative valuation. Absolute valuation is when an analyst estimates future earnings and then in turn estimates how much those estimates are worth in today's money. Relative valuation is when an analyst compares a company to another similar company or to the overall market to divine relative value. This process is more intuitive than absolute valuation. It is akin to a shopper in a store comparing one loaf to another to see which is the better buy. Both approaches are grappling with the same unknown. What is a fair market value for the company in question? Before we dive in, let's outline the pros and cons of each method. What are the pros of absolute valuation? It is precise as it rests on detailed assumptions about the future, such as the price per gallon of fuel for an airline. It is derived from the profit generated by the company. It therefore forces an analyst to think about how a company ultimately makes money, which engenders a healthy skepticism of companies that have not yet made money. The process of framing the model and generating the assumptions means that an analyst needs to think through the full business model. What are the cons of absolute valuation? The problem with projecting future earnings is that you have to predict the future. It demands a detailed model of all the company's major revenues and costs, which is time-consuming to produce. An unscrupulous analyst can quite subtly manipulate the more sensitive assumptions in order to provide the desired answer. And what are the pros of relative valuation? It's a relatable process, as it is just like comparison shopping at the supermarket. A very similar item for a lower price is a better buy. The mathematics is simple. It's the comparison of one valuation metric to another. It demands shorter range forecasts than absolute valuation, typically 1 year. And what are the cons of relative valuation? It provides an opinion that a company is undervalued or overvalued, but it typically doesn't provide an estimate of how much the company is actually worth. Just like snowflakes, no two companies are alike. Relative valuation uses other valuations as reference points. But who's to say that they are in turn fairly valued? Absolute valuation, otherwise known as discounted cash flow valuation, is a 5-step process. It boils down to estimating cash flows of a company into eternity and figuring out how much those cash flows are worth today. This can then be translated into a market capitalization and therefore share price. The 5 steps are: 1. Estimate long-term future cash flows from the firm. 2. Estimate the rate at which to discount those cash flows to derive today's value. This rate is known as the weighted average cost of capital, or simply the WACC. 3. Take the outputs from steps 1 and 2 and discount the estimated future cash flows by the WACC. 4. Take this total firm value and, from it, derive the market capitalization. 5. Slice up the market capitalization by the number of shares outstanding to arrive at the estimated fair share price. First, let's estimate long-term future cash flows. Absolute valuation involves valuing the whole firm. Most firms have both lenders, bondholders, and owners, shareholders. We saw earlier that shareholders are entitled to the residual earnings after all other stakeholders, employees, suppliers, lenders, and the tax authorities have been paid off. This is why when we looked at Ford's income statement, we highlighted the earnings row, the proverbial bottom line. To do an absolute valuation, however, an analyst must instead look at the whole firm's cash flows. The analyst will use his company projections of revenues and costs to project this so-called free cash flow. Note that this does not mean that the cash is free of charge in some way. It simply means that it is the cash that the firm has available for both bondholders and shareholders. The derivation of free cash flow from the revenue and cost projections is rule-based. The hard part of generating these projections is not so much the mechanics as it is making the required assumptions about the future. Now that you have long-term future cash flow estimates, the second step is to calculate the rate at which you will discount those cash flows. This is known as the weighted average cost of capital, or the WACC. There's a saying that a bird in the hand is worth two in the bush. Given the inherent uncertainty of the future, people are willing to trade the promise of a larger sum tomorrow for the certainty of a lower sum today. This is the reason why investors assign a lower value to or discount the future cash flows. What percentage rate should investors use? Well, if an investor has a pot of cash today and he is pondering whether to invest in a company, remember, he could always simply buy U.S. Treasury bonds. U.S. government bond yields, therefore, set the baseline for the discount rate for equity investors. But remember that U.S. Treasuries are risk-free. Firms are not. Unlike governments, they don't have taxpayers or currency printing presses to fall back on. Accordingly, investors need to discount their cash flows at a higher rate than the government bond yield in order to reflect the added risk of investing in a firm. How much higher? A typical firm is financed by both shareholders and bondholders. Equity and debt have different risk profiles, as we saw in the Jenny example, and therefore have different discount rates. The discount rate used for the overall firm is a blend of the discount rates for the equity and debt, blended in proportion to the relative split of equity and debt financing. Let's show how this works mathematically. Let's pull up the suggested weighted average cost of capital for Delta Airlines using the WACC function. This is a blend of Delta's cost of equity and cost of debt, blended in proportion to the relative split of Delta Airlines' equity and debt financing. To arrive at this number, one has to first calculate the proportion in which Delta's financing breaks down between equity and debt. This is displayed in the pie chart at the top right of the page. The blue chunk represents the market capitalization of Delta Airlines, that is, the share price multiplied by the number of shares. The yellow and red chunks represent the debt of Delta Airlines, which stems from both Delta's bond market values and from non-listed debt instruments, such as bank loans. Here we can see that the blend for Delta is 81% equity and 19% debt. So what are the discount rates for its equity and debt? The cost of equity for Delta is 11.4%, while the cost of debt is 1.9%. Now, we blend these two discount rates together in an 81-19 proportion. And this gives us the weighted average cost of capital that we will use to discount the cash flows. The cost of debt is calculated from the yield on a firm's bonds. We already saw in the fixed income module that corporate bond yields are typically higher than government bond yields due to the greater risk. Where did Delta's 11.4% cost of equity come from? Equities are riskier than bonds. People expect to be compensated for taking this extra risk. Equity investors expect annual returns greater than government bond yields. The question is, how much more? The calculation that people use is based on the capital asset pricing model. This uses the general riskiness of the stock market as a starting point. It then takes into account the volatility of the stock being valued compared to that of the overall market in order to calculate stock-specific risk. It thereby uses stock volatility as a proxy for the riskiness of the earnings estimates. Let's walk through the six-step process to estimate the cost of equity. We'll call them steps A through F. Step A is to take the 10-year government bond yield. If we type WB into the command line, we see that at the moment this screen was captured, the 10-year government bond yield was 2.19%. Step B is to calculate the historic overall market return. If we type country risk premium into the command line, we can call up the CRP function, which has the inputs we need. Here we can see that based on historic performance, we may expect a return of 9.47% from the U.S. stock market. Step C is to calculate the market risk premium. If we go back to the CRP function and click on the United States row, this number is in the final column. It is calculated by taking the market return minus the 10-year bond yield, 9.474% minus 2.191%, equals 7.283%. Step D is to consider how much riskier this stock is compared to the overall market. Investors refer to this relative volatility as beta. If we pull up the beta function for Delta Airlines, we can see that the calculation is based on a regression. Delta Airlines is domiciled in the U.S. Therefore, the regression is between the daily returns of an American index, the S&P 500 on the x-axis, while the daily returns for Delta Airlines are on the y-axis. The function runs a regression between the two data sets to estimate the best fit line. The beta is the slope of this best fit line. It is a measurement of a stock's sensitivity to the movement of the overall stock market. A stock with a higher beta has a steeper best fit line and will tend to move in an exaggerated way relative to the movement in the market. A stock with a lower beta has a shallower best fit line and will tend to be subdued relative to the overall market. In this case, Delta Airlines beta is 1.26. Step E is to multiply this beta by the previously calculated expected market return. This gives us what is known as the equity risk premium for Delta Airlines. In this instance, 7.28% expected market return multiplied by a beta of 1.26 gives an equity risk premium of 9.17%. Step F is to add back the risk-free rate to this equity risk premium. 2.19% plus 9.17% is approximately 11.4%. At last, we have Delta's cost of equity. You'll be relieved to hear that Bloomberg continually updates the inputs and calculations for the cost of equity within the WACC screen. We can see this by going back to the WACC function for Delta Airlines and clicking on the cost of equity number. It takes the 10-year bond yield from the WB function, 2.19%, and the market return from the CRP function, 9.47%. It then subtracts the 2.19% from the 9.47% to give the country premium of 7.28%. The WACC function then takes the beta from the beta screen, 1.26, and multiplies it by the 7.28% country premium that we just calculated. This gives the 9.17% equity risk premium. The WACC function finally adds back the 10-year bond yield, 2.19%, to the calculated equity risk premium of 9.17%, which finally gives us the cost of equity of 11.36%. Many investment bankers and investors opt to simply pull the WACC from the Bloomberg WACC function. It's automated. It'll save you a lot of time. Now that we have the future cash flow estimates for the firm and the discount rate that we will use, we can go ahead and discount the cash flows at the WACC. Here are the estimated cash flows that were projected from Ford's historical performance that we saw earlier. They run from 2014 to 2040. We now use Ford's WACC to corrode the value of the future cash flows. What we're trying to do is calculate the size of the pot of gold at the start of the period. The estimated value of the firm at this point is the total of these discounted cash flows. You will notice how cash flows, while in theory going on forever, rapidly diminish in value the further out they go. You will now appreciate that the riskier the firm, the less you will value the future cash flows. If the WACC were 8%, you would value the cash flows at far less than if the WACC were 3%. Now that we have estimated the value of the firm, we can estimate the value of the equity. That is, the size of the loaf of bread or estimated market capitalization. To visualize this step, let's pull up the enterprise value for Delta Airlines, that is, the total value of the whole firm, by selecting the EV function. This was the striped blue bar that we just calculated. On this chart, the enterprise value is the right-hand bar, which here is $42.3 billion. Recall that one uses the free cash flow for all stakeholders when doing an absolute valuation. The enterprise value therefore belongs to both bondholders and shareholders. As we are trying to calculate the value of just the shareholder's stake, that is, the size of the loaf, we therefore need to subtract the value of the bondholder's stake, which in this case is $9.8 billion. This value is typically calculated from the trading value of the bonds or from the value of the debt on the balance sheet of the firm. Cash balances also belong to the shareholders along with the earnings. As a bank balance is not captured in the earnings forecast, we need to add them on to arrive at the estimated loaf size. In this case, Delta has $3.3 billion in cash. So we have an enterprise value of $42.3 billion. We remove the $9.8 billion owned by bondholders. We now add the $3.3 billion of cash owned by the shareholders. This gives us a loaf size or total equity value of $35.8 billion. Now that we have estimated the size of the loaf, can you guess the final step? Divide the estimated equity value by the number of shares to arrive at the estimated fair share price. So, to recap the absolute valuation process, first, you painstakingly estimate future cash flows for the firm by honing a set of assumptions about the future. Second, you estimate the discount rate, the WACC. Third, you discount the future cash flows using the WACC. Fourth, you subtract the value of debt and add on any cash to arrive at your estimate of equity value. Fifth, you divide the market capitalization estimate by the number of shares to give you your estimated fair share price. Steps 2, 3, 4, and 5 are relatively mechanical. The artistry of absolute valuation is in the first step, formulating well-thought-through assumptions on what the future holds for the firm in question. Now that you know the absolute valuation process, let's make some observations. First, building a forecast of a company's performance seems like a precise activity as it is done with accounts and formulae. We saw this sense of clear precision with the Delta Airlines estimates. It is easy to lose sight of the fact that forecasting is an attempt at predicting the future, and that the future is fundamentally unknowable. We only have to look at the concept cars and jetpacks from the 1960s to see that. Or, more recently, at Google. At the 2004 IPO, no analyst of the small 2,000-person company foresaw Google Maps, the YouTube acquisition, Chrome, Android, or the Google car. The word mobile appeared only 6 times in the offering document. Let's show an example of how hard it would have been to foresee the commercial success of a string of Apple innovations. In 1997, Microsoft was performing strongly, having released Windows 95. Apple was struggling, and so, in August of that year, rehired Steve Jobs. 2 months later, computer entrepreneur Michael Dell, founder of PC manufacturer Dell, said when asked about Apple that he would shut it down and give the money back to shareholders. In 2001, Apple launched the portable music player, the iPod. In 2003, the online music store iTunes. In 2006, Apple TV. In 2007, the iPhone. In 2008, the App Store. In 2010, the iPad. And in 2015, the watch. After the launch of the iPod, Apple's revenue multiplied many times over the following years. Michael Dell's crystal ball seems to have malfunctioned. 10-year bond yields are foundational to the WACC. The lower the 10-year bond yields, the lower the WACC. The lower the WACC, the higher the estimated share price. This is how interest rates influence share prices. Perhaps the very low U.S. interest rates from the 2008 rate cuts to the first rate hike in December 2015 accounted for the tripling in the S&P 500 over that period. Oddly, the connection is not as strong as you might think. All things being equal, companies tend to grow faster in an accelerating economy, which causes analysts to lift estimates, so making equities more attractive. But all things are never equal. In this scenario, a central bank would typically be lifting interest rates, which elevates the WACC, so making equities less attractive. Economic growth and interest rates offset each other when it comes to stock market valuation. An analyst has to be on top of the earnings cycle and the interest rate cycle to form a view on where the stock market is going next. Recall when we outlined the discounting process that we were silent on what happened in the very long term beyond the end of the bar chart. Company cash flows can continue for decades or centuries, provided the company lasts that long. For example, consumer goods company Johnson & Johnson, one of the biggest companies in the U.S., was founded in 1886. If a company like Johnson & Johnson can survive for centuries, why isn't its share price extremely high to reflect centuries of cash flows to come? Recall how when we discounted the cash flows earlier, the WACC increasingly corroded the value of the longer-term cash flows. No company can grow faster than nominal GDP growth in the long term, or it would subsume the global economy. Therefore, long-term company revenue growth is limited to nominal GDP growth, which, as we saw in the Economic Indicators module, has averaged about 5% over the last 70 years in the U.S. WACC, meanwhile, is typically higher than nominal GDP growth, 8% being a common level. This means that WACC will ultimately grind down the value of company cash flows to nothingness. This is why the very long run is unimportant to equity investors, because in the long run, we are all dead. Or in finance jargon, WACC is greater than nominal GDP growth. Heavily indebted companies have more volatile share prices than companies with no debt. This is because when the total value of the firm changes, the amount owed back to bondholders does not. Therefore, the piece owned by the shareholders, the market cap, moves sharply. A useful analogy is a mortgage. Say you are a wealthy property investor and are convinced that houses in a certain neighborhood are set to skyrocket. You decide to buy a $500,000 house. Do you pay in cash, or do you borrow to the hilt? You should borrow to the hilt if you are absolutely convinced that the area is going to be hot. Let's say you buy the house with an 80% mortgage, borrowing $400,000 and throwing in $100,000 of your own cash. Turns out you are right. The following month, another property investor comes along and offers you $800,000 for the house. You accept the offer, hand $400,000 to the bank to pay off the mortgage, and are left with $400,000 in cash. So while the house went up 60% from $500,000 to $800,000 by the alchemy of debt, you turned $100,000 into $400,000. This alchemy is also on offer in the stock market. Let's pull up the enterprise value for retailer Target. Here we can see that the whole firm is worth $60.1 billion. It has $12.8 billion in debt and $2.2 billion in cash. Therefore, the market cap, or value of equity, is $49.5 billion. Imagine if you thought that the absolute valuation of Target should instead be 66% higher at $100 billion. As the value of the debt and the cash remain the same, the value of equity rises 81% from $49.5 billion to $89.4 billion. This is exactly like the house example. Debt magnifies the returns on offer to shareholders because bondholders do not benefit from the whole firm becoming more valuable. The shareholders still give them whatever fixed income was promised to them. So shareholders benefit disproportionately from the firm getting more valuable. For heavily indebted companies, a small shift in the value of a firm can cause a large shift in the share price. As many companies are indebted, this is one major reason why equities are more volatile than bonds. The whole process of absolute valuation has many inputs and moving parts. It therefore has a multitude of sensitivities. Several of the inputs, as we have seen, are quite changeable, and these changes may have nothing to do with the company in question. Therefore, it is not sufficient to be an expert solely on the company and industry specifics in order to have a handle on valuation. This is one of the main reasons for the volatility of equities. You are the owner of residual income in a messy world. Here are some examples of common sensitivities to be mindful of when valuing a company. Estimates will be affected by the economic cycle. For companies operating around the world, revenue and costs may be in other currencies, which therefore will be buffeted by moves in the FX market. Many companies are affected by the commodity markets. Exposure to things like oil, metals, or grains will bring into play factors which affect the prices of those commodities. WACC will be affected by moves in the overall stock market, which change the equity risk premium, and by moves in the 10-year bond yield, which changed the risk-free rate. Finally, the share price itself can affect the share price. For example, a company with a very high share price can raise funds for growth more easily, which may improve the company's prospects. Conversely, a company with a very low share price may spread fear of bankruptcy among customers who then pull their business. Most analysts either do not model these factors or, if they do, assume that the factors are static into the future by flatlining the oil price, for example. This is why these larger forces endlessly surprise investors. And this is why absolute valuation, with its detailed spreadsheets and precise outputs, can lull analysts into a false sense of confidence. This confidence is misplaced. Hence the old joke that the stock market is 99% confusion, 1% commission. To wrap up our discussion of absolute valuation, let's recap the pros and cons. The pros: it delivers a precise answer. It is tethered to earnings, making it a useful tool to spot overvaluation. It forces you to think through all the revenues and costs. The cons: it is hard to predict the future. Building an absolute valuation model is time-consuming because it is comprehensive. You can easily boost an absolute valuation by slightly raising the long-term growth rate or slightly reducing the WACC. Think you grasped these concepts? Answer these questions to check your understanding. To summarize, absolute valuation involves the long-term guesstimation of company profits and the calculation of how much those profits are worth today. The main driver, therefore, is how well you think the company will perform. $100 in 10 years' time is worth less than $100 in 2 years' time. A bird in the hand is worth two in the bush. Financial models are simplifications of reality. The trick is to be simple enough to be understood while being complex enough to approximate reality. Simple, not simplistic. The advantages of absolute valuation are its precision, rigor, and link to the fundamental performance of the company. The absolute valuation process is undermined by the need to make long-term predictions and the sensitivity of the output to a few key inputs.